When intense, kinetic market momentum hits a wall, the resulting silence is rarely an accident. Right now, institutional liquidity has come to a dead stop. We are analyzing the post-market closing data for Wednesday, August 26, 2026. The major indices have frozen, and we need to map out exactly why. Confirming this across the broader market, this chart of the S&P 500 mirrors the exact same holding pattern. Look at this final series of one-hour candles. There is almost zero vertical price expansion. The aggressive recovery we saw in mid-August is completely paralyzed. The market has deliberately slammed the brakes and is outright refusing to pick a direction. Technical analysts define this specific behavior as volume contracted consolidation. It tells us precisely how to interpret the flat price action. Returning to the S&P 500, we need to look strictly at the bottom panel of this chart to see the volume histogram. This proves that the lack of price movement is being driven by a severe lack of market participation. Notice the steady, undeniable decline in these volume bars over the final 48 hours. As the volume drops off, the price range narrows right alongside it. Standard momentum trading strategies rely on high participation to follow through on breakouts. Because participation has vanished, attempting to trade momentum here will inevitably lead to buying tops and selling bottoms. A true market top typically forms with high volume distribution, where large players aggressively offload shares. What we have here is low volume consolidation. Shorting into a low volume environment is highly dangerous because a sudden return of liquidity can easily squeeze the price upward. Institutional capital is not fleeing the market in a panic. Instead, these entities are intentionally stepping away from the order book, creating a deliberate liquidity vacuum. This raises an immediate analytical question. If the major index pricing is frozen, where is the underlying institutional capital actually flowing? This heat map reveals turbulence beneath the flatline. We see a highly fragmented environment, with capital aggressively inflating defensive megacaps like Microsoft and Apple. Their sheer size artificially props up the index, masking the fact that capital is heavily bleeding from key growth sectors like NVIDIA and Eli Lilly. We define this opposing dynamic as internal sector friction. The heavyweights on the defensive side are directly canceling out the cyclical heavyweights at the index level. This creates a stock picker's environment, heavily punishing trend traders. Broad indices cannot break out when internal sectors fight for directional control. Smart money is actively rebalancing risk, rotating out of aggressive growth and hiding in defensive tech without triggering a broader index move. To understand why institutions are rebalancing instead of initiating new trends, we have to shift our focus from internal chart mechanics to the external macroeconomic forces dictating their behavior. This economic calendar pinpoints the exact source of market hesitation. Thursday's unemployment claims data lacks the macroeconomic gravity to break capital out of consolidation. The true paralysis driver is Friday's massive event cluster, the Jackson Hole Symposium, and inflation expectations. We call this macrogravity. When a cluster of critical data releases looms on the horizon, it sucks liquidity out of the preceding days. Institutions refuse to place large directional bets right before the rules of the game might change. The Jackson Hole Symposium carries immense stakes. The rhetoric used by central bank officials here directly dictates global capital flows and the cost of borrowing. These Fed speeches, combined with inflation expectations, create extreme asymmetric risk. A single hawkish sentence can instantly invalidate any technical setup formed today. Committing heavy capital to a directional breakout today is mathematically irrational. The risk profile is entirely skewed by Friday's binary event risk. Knowing the macro environment is paralyzed, we must outline the strict tactical parameters required to navigate tomorrow's trading session without suffering unnecessary drawdowns. Returning to this chart of the S&P 500, we can define the exact boundaries of our trading sandbox. We define the absolute floor of the current consolidation zone at 7,650, establishing the critical support boundary. We then define the ceiling at 7,725, the immediate resistance boundary keeping the price boxed in. For Thursday's session, the probable price action will consist of liquidity grabs, false momentum spikes, and erratic chop strictly contained within these two specific lines. Do not buy breakouts during this session. Low volume guarantees that any push past these boundaries will be a violent fakeout designed to trap retail capital. Strictly respecting these horizontal boundaries is the only mathematical way to avoid getting chopped to pieces by pre-news volatility. To survive a low-volume, high-risk environment, we rely on a mechanical logic matrix. This removes emotion from the execution entirely. First path. If price tests the extreme 7,650 or 7,725 boundaries, execute a mean reversion trade targeting the middle. Alternatively, if price attempts a breakout, do not engage. Assume it's a trap. However, the highest probability decision is the simplest. If price chops inside the range, sit in cash. Retail traders often feel anxious when they aren't in a trade. Professionals understand that sitting in cash is an active, strategic position. You are deliberately choosing to protect your downside. If you execute trades on Thursday, you must follow a mandatory risk rule. Your standard position sizing must be slashed by at least 50%. The sole objective for Thursday is capital preservation. You must ensure your full account balance is intact and ready to deploy when Friday's true directional catalyst finally arrives.